We've been getting this question over and over again. Should I refinance my mortgage during COVID-19 because interest rates are lower? And the idea behind mortgage refinancing is simple. You find a better rate out there, you close your current mortgage, get a new one, and your monthly payment is lower and you save on total interest costs. There are two problems with it. Number one is transaction costs, because usually you'd have to pay some sort of penalty fees to close your current mortgage, and to get a new one you might pay for appraisal or title fees. So you have to total that together and take it into account to calculate if refinancing actually makes sense. Second problem is a lot of people, when they refinance, instead of sticking with their term that remained in their loan, they're taking a brand new mortgage for like 30 or 25 years, which makes monthly payment way lower, but you're extending the time you're paying the interest by years, and then total cost might actually be higher than if you are stuck with your current mortgage. So let's look at all of the considerations for mortgage refinancing. And number one is obvious: did the interest rate actually go down? If we look in 2019, the lowest rate was 3.63% and average was 4.25%. Now during the crisis, COVID-19, we all saw the news that Fed dropped the overnight rate to zero, and now the debt is cheap. So as a consumers, we kind of hope to expect that the interest rate we're paying are lower and banks are passing those savings to us. But let's be honest here, banks are in the business of making money, and they make a lot of money from the interest, so it's not in their interest to reduce those rates. So even if they do it, they'll probably do it in the slowest manner possible. So I looked at refinance rates on April 14th, and you could see it's almost 3.7%, 3.85% compounded, which is higher than in 2019. And by the way, the refinance rates are usually slightly higher than a brand new mortgage. That doesn't mean you can't find a better rate than what you're paying right now. Perhaps when you got your original mortgage, your credit history was not as good, or you have a credit union in your area that runs a very aggressive mortgage promotion. So let's assume that you did find a better rate and go down in that list of considerations. The next consideration is current mortgage qualification. Because of the crisis and COVID-19, a lot of people lost their jobs. Even the ones that didn't lose their jobs probably see their income reduced significantly. And banks are highly aware of that, and that's why they're strengthening the rules to qualify for mortgage. You now need to have a higher credit score, and they're asking for proof of income 3 days before mortgage is closing. Before it was 2 weeks. Even if you found a better rate and you're considering refinancing, you gotta make sure you actually qualify for current mortgage rules. Which leads me to the next consideration is, what's your current credit score and how it changed from the time you got your original mortgage? If your credit score went up since the first time you got your mortgage, perhaps you can get a better rate. But if your credit score went down, especially in this financial situation, you're probably not going to qualify for all of those amazing refinance offers you see advertised. So let's say you qualify for the mortgage, you found a better rate. The next thing you got to look at is transaction costs. And usually, if you're closing your current mortgage earlier, you'll pay penalties for that. For the new mortgage, you'll have to pay the same fees you originally paid, like appraisal fee, title fee, recording fees. And it's very important to know what they are in total and be very clear about it. Because what bank is going to do is they're going to try to roll it into your mortgage so you feel it less, but in reality, you just end up paying more interest over the time. So when you evaluate the savings you get with a better rate, you gotta put the closing costs on top of it to see what the break-even point is. So say you qualify for the mortgage, you found a better rate, you're okay with the transaction cost. The last thing you gotta look at is the term of the loan. So say 7 years ago, you got a 30-year mortgage, so you have 23 years to go. If you refinance right now for another 30 years, your monthly payment is gonna go significantly down. However, your total interest costs are gonna go way up because you'll be paying extra 7 years, and thus kind of defeating the purpose of the whole mortgage refinancing. So when you refinance, make sure that your remainder stays the same, and you don't have to stick with like 15 or 30 or 25 year mortgages. If you have 19 years left, you can just refinance for specifically 19 years. So if you found a better rate, you qualify for the mortgage, you're okay with the closing costs, let's look at the calculators on our website just to see what numbers make sense. So I wanted to put it all together and use our calculators to see the actual numbers and see what makes sense. So for example, 5 years ago, I got a 30-year fixed mortgage for $250,000 with the interest rate at that point, it was 4.6%, and it was for 30 years. My monthly payment right now would be $1,281. I also want to see after 5 years what would be my balance, which this will be the balance of the loan. I then go to my Refinance Calculator. I already inputted the payment, and then I'm gonna put the mortgage amount. Because we've been paying it for 5 years, I don't want to extend my term, so it's 25 years. Interest rate is the reduced one by 1%, 3.6%. Closing costs, which we talked about, can be appraisal fees, title fees, penalties, 1,000. And then there's also mortgage points, which banks usually charge around 1%. Which is a fancy way to increase closing costs really by telling you that you're prepaying the interest. When you look at the results, you'll see that the total closing cost with the mortgage points is $5,282. And taking those closing costs into account and your lower monthly payment, it will take you 42 months to break even in that. So if you were staying in your house longer than that, it will probably make sense to refinance, taking into account that you're not extending the term of your loan and there is a full percent reduction in the interest rate. If the reduction in interest rate is smaller, you will see that the break-even point goes to 5 years right away. Using those two calculators, you can quickly see money-wise, even if you qualify for the mortgage with the new rules, and the interest seems a little bit lower, does it make financial sense to refinance?